Have you ever opened your trading app, scrolled through a wall of tickers, and thought, how do people keep track of all this? The truth is, they don't. Smart investors and traders don't try to watch everything. They build a watch list. A good watch list cuts through the noise, focuses your attention, and makes sure you're prepared instead of reacting emotionally. But here's what a lot of beginners miss. Not all watch lists are the same. A watch list built for long-term investing looks very different from one built for short-term trading. The time horizon shapes everything: what you track, why you track it, and how you use that information. Let's start with the long-term side. If you're investing for the long run, your watch list isn't about chasing every price spike. It's about monitoring strong, stable companies that you want to own for years. These are businesses with real earnings, solid balance sheets, and consistent growth. Think companies like Apple, Microsoft, or Nvidia, companies that dominate their space and have a history of rewarding shareholders over time. Long-term investors also track index funds like SPY or QQQ. These give you exposure to the broader market instead of betting on individual companies. By keeping these on your watch list, you're not just watching one stock, you're watching the heartbeat of the entire market. And here's a smart move a lot of experienced investors use. They also keep inverse ETFs on their radar. If the S&P 500 goes up, funds like SH move in the opposite direction. Even if you never buy them, watching these tickers gives you a better feel for shifts in sentiment and potential downside pressure. Now let's flip over to short-term trading. This is a completely different game. A short-term trader isn't looking at balance sheets or 10-year growth plans. They're looking for movement, volatility, momentum, and setups that can play out in hours or days. A short-term watch list might include small cap names, hot biotech stocks with catalysts, or high-volume movers with clean technical setups. If long-term watch lists are slow and steady, short-term ones are fast and dynamic. Traders often rebuild or rotate their watch list daily or weekly, focusing only on names that are currently active. It's about staying laser-focused on where the action is right now. Once you know which lane you're in, long-term, short-term, or a mix of both, the next step is to define your strategy. A watch list with no purpose is just clutter. If your goal is to grow wealth slowly, your list should reflect quality and stability. If you're trading actively, it should reflect liquidity, volume, and technical setups. And here's something important. Don't overload your list. A lot of beginners think more tickers equals more opportunities. In reality, it equals more distractions. A focused long-term watch list might have 10 to 20 names. A short-term watch list might have 5 to 10. That's more than enough to keep you busy and informed without getting lost in the noise. A structured watch list is much more powerful than a random one. Instead of one big list, break it into sections. You might have one for core holdings, another for growth names you want to accumulate, another for dividend or income plays, one for momentum setups, and a final one for index and inverse ETFs to monitor the bigger picture. This makes it instantly clear where to focus your attention when the market moves. But how do stocks actually earn a spot on your list? That's where criteria comes in. For long-term investors, it might be stable earnings, strong cash flow, or consistent dividend growth. For short-term traders, it might be high relative volume, clean price structure, or a specific technical pattern. Whatever your criteria, be intentional. Don't just throw in random names because they're trending online. Once you've defined your structure, choose where to build it. Some people use their broker's built-in watchlist tools. Others prefer TradingView for charting and alerts. And plenty of investors just use spreadsheets to track fundamentals, dividend yields, support and resistance levels, and upcoming catalysts. The best system is the one you'll actually keep up with, and that brings us to something crucial: updating your watch list. A static list becomes useless fast. A good watch list evolves with the market. If a ticker falls out of play, take it off. If something new starts moving, add it. Long-term investors might update quarterly or monthly. Short-term traders might adjust every day. This habit keeps your radar clear and your focus sharp. It's also smart to include some key metrics next to each ticker, things like average daily volume, 52-week range, support and resistance levels, or upcoming earnings dates. That way, when something moves, you already have the context you need to act instead of scrambling for information. And don't just watch bullish setups. If you're serious about understanding market direction, track both sides. Watching inverse ETFs or volatility products alongside your main list gives you a better read on what's actually happening. If your growth stocks are pushing higher but volatility is creeping up, that can be an early warning sign. If inverse funds are trending while indexes flatten, that might be a shift in momentum. At the end of the day, a watch list doesn't make you money directly. What it does is put you in position. It's the difference between chasing random spikes and being ready when opportunity shows up. For long-term investors, it's about being patient and prepared to build positions in quality companies or indexes when prices are right. For short-term traders, it's about knowing exactly which tickers to pounce on the moment the setup confirms. When markets get chaotic, and they always do, your watch list is your anchor. It cuts through the noise, keeps your attention where it matters, and helps you act with intent instead of emotion. A good watch list isn't just a list of tickers, it's a plan. And when you build it right, it gives you an edge most people don't have.